Hi, this is PR Sundar, and in this episode we are going to discuss about put call ratio, and many people use the put call ratio as an indicator to judge the market, whether the market is bullish or whether the market is bearish. And first let me explain what is put call ratio and then what is its significance and how people interpret the put call ratio. First let us look at the definition. What is put call ratio? Put call ratio is a measurement that is widely used by the investors to gauge the overall mood of the market. A put or put option is a right to sell an asset at a predetermined price. A call or a call option is a right to buy an asset at the predetermined price. If traders are buying more puts than calls, it signals a rise in the bearish sentiment. If they are buying more calls than puts, it suggests they see a bull market ahead. Okay, now let me explain to you. More people are buying a put option, or more people are buying call option, or more people are selling put option, or more people are selling call options. So from where do we get that? If you go to nseindia.com website and you see the option chain and you can see the open interest here. So I've taken the Nifty, this monthly expiry, and if you scroll down, at the end you can see the total call option open interest. 4 crore 25 lakh shares, that is the total open interest in put options. On the left side, if you see total 2 crore 33 lakh shares, that is the total open interest in the call options. So that means totally 4 crore 25 lakh shares has been traded in the put options and 2 crore 33 lakh shares have been traded in call options. Now what is the put call ratio? All you have to do, you have to open an Excel sheet. So here you copy the total put options. So these are total put options, and here I am going to enter total call options. So if you find the ratio, that means total put divided by total call. So now this shows the total put call ratio at 1.81. So the put call ratio as of today, it is 1.81. You can get this data. You go to any YouTube channel or any website, you can get this data. But now listen to me very carefully. How do I interpret? I interpret it differently. First, let me tell you the market perception. Whenever put call ratio is above 1.7, the crash can come anytime. In 2008, January month, the very big crash came. That time, the put call ratio was more than 1.7. Uniformly, big crashes came when the put call ratio was more than 1.7. The same way, if the put call ratio is below 0.8 and markets tend to bottom out and tend to rally from there. Most of the time, markets have bottomed out when the put call ratio was at 0.8. Now, the question is 1.7, anything more than that is very dangerous. But now we are already saying 1.81. Should we be worried about a big crash by looking at the put call ratio? In my opinion, the answer is no. Here, the put call ratio is taken by taking all the open interest. If you look at option chain, 15,000 call option is also being traded. 36,000 open interest is there. Do you think market is going to go to 15,000 by the end of this month? 99.9999% I am sure it's not going to go. Or if you look at 5,000 put option, there's a 26,000 open interest. And do you think market is going to go below 5,000? 99.99% it's not going to go. So why do we take 5,000 put option and 15,000 call option for the study of put call ratio? That looks illogical for me. So therefore, I don't take this total put divided by total call. Instead, what I do, if it is a month beginning and I take about 1000 point down and 1000 point up, because normally markets don't make a move of more than 1000 point in a month. And now for the December series, 2 weeks is already over. So we have only 3 more weeks, and even in 3 weeks also, we are going to have only 13 more trading sessions because one trading session is a holiday. So we have only, today Friday is over, so we have only 13 trading sessions, which means that half of the month is already over. So because we are left with only half of the month, I can assume that a Nifty can move a maximum of 700 or 800 points. A market closed around 13,500, and I have an Excel file here. So I copied the open interest here, the data, because we don't need to see all those data. We don't need to see bid price, ask price, quantity, LTP, IV, all this we don't need. I just copied this data here. Because the market closed around 13,500, I am taking about 700 point down and 700 point up. So that means 12,800 to 14,200. Okay, so you can see this. You can see here is 1 crore 66 lakh 85,625. Let us take it approximately 1.67 crore. The put is 1.67 crore. The put option is 1.67 crore. Now, same thing you take it for a call option from 12,800 to 14,200. This call option you can see it's showing 1 crore 49 lakhs 40,000. So let us say it is 1.49. So 1.49 crore. And if you calculate the put call ratio, so it is showing only 1.2. So when we take the entire open interest, the put call ratio is working out to be 1.81, and I am taking a reasonable level of 700 point. If it is a month beginning, you can take about 1000 point. So the put call ratio is only 1.12. So therefore, there is no risk of big crash for the next few weeks. So normally people take put call ratio for the entire option strikes, but I do not take put call ratio for the entire strike prices. I choose a range within which the markets are likely to trade. Usually it's about 1000 point if it is a month beginning, 800, 700 point of the month. And because the put call ratio is 1.12 only, this shows that the market is slightly bullish only. So anything more than 1.7, you have to be worried. You have to be very, very cautious on the long side. And anything below 0.8, you have to be very, very, very cautious on the short side. Now, it is somewhere in between, so there is nothing to worry about market crashing anytime soon. So, I hope you have enjoyed this video. Thank you for watching.